I've got nearly 40 years of banking experience. So you can guess if it's been out there, I've seen it in most cases. So I think that's pretty valuable. And it's all been community banking, so very relationship driven and being able to connect with people that way. So today I thought what we talk about is a wide variety of different things, but particularly about cash flow and the importance of cash flow. But along with cash flow becomes equity, capital, and the importance of capital too, because cash flow starts with capital, okay? And there are two forms of capital generally that we see businesses on businesses' balance sheets. There's debt, which can be a form of capital, and you've got cash equity as well. You've got to have the capital in place in order for your business to succeed. Because over the years, the one thing I've seen more than anything from businesses when they start out thinking that they can get by with just a minimum amount of capital, is that they're undercapitalized and they get off to a bad start and then they try and catch up, and before you know it, they're behind the eight ball because they didn't have enough capital to work with. Even though you may have a great business plan, which is the other component of starting a business, you've got to have a good business plan. The fact is you're going to run into things that you didn't see, and that's always the case. Whether it be from a marketing perspective or a downturn or whatever it might be, but there's always going to be things that come up. And every business has business cycles. You know, you have your startup phase, and then you have your growth phase, and then you have your sustainable phase. And each one of those cycles requires different levels of cash flow as well. Startup phase, obviously, you're going to have a lot of expenses on the front end. So you've got to have enough cash to make sure that you can manage those startup expenses. It's overhead, it's insurance. I mean, there's a lot of things that contribute to overhead. As you grow, your growth is going to be such that you're generating a lot of revenues, but you're also growing at the same time, so your expenses and your overhead are going to increase at the same time too. And you generally can't, most of the time the profits, even though they may be good, don't keep up with the growth rates if you're a growing business. And then you have the phase where you've peaked out, you've got a sustainable group of clients, and then at that particular point, then your profits should be sufficient enough to maintain the operations. But in a lot of cases, a lot of what I've seen happen is that most of the companies need some form of an operating line of credit or something. And even on the beginning stage and in the growth stage, they need that as well. But they maybe just need a line of credit just to weather the seasonality of their business or peaks and valleys of cash as it comes in throughout the year as well. So cash is important, but it comes in two forms. Bank debt can be part of that, subordinated debt as well. We can get complicated about that, but it's primarily bank debt and or cash equity in the businesses. So from the bank's perspective, what we look at is when you come to a bank for a loan request, a lot of people think, well, if I have collateral, that's all I need. You can find collateral lenders out there. There are banks that do nothing more than if you've got the collateral, we'll loan you the money, and that's fine. But what banks generally look at is a couple things, collateral being one of them, but primarily the cash flow, and the cash flow to support the debt, because that's how we're going to get repaid. So when a bank analyzes the loan request, what we're going to look at first is everything, but we're going to look at, is there going to be sufficient cash flow to support any debt? So again, depending upon what the request is, it could be multifaceted. It could be, a request for real estate or fixed assets. It could be for an operating line of credit. It could be, just working capital in general and term it out. But it can be a lot of different things. So what a bank should do, and we do this, is making sure that your debt structure is done right so that you don't choke off your cash flow. Because that's the worst thing that you can do is not have sufficient cash to support debt service for one thing, or cover your overhead. In a lot of cases, what a lot of banks will do also is put in debt service requirements, coverage requirements. So if you've got, particularly on fixed asset purchases or capital purchases, so if you've got a building or a large piece of equipment or several pieces of equipment that you want to finance, we may put in a debt service coverage requirement of, let's say it's 120 to 1, which means that you've got to have 120% of net income to support that 100% of debt. So if your debt payments are, let's say, $1,000 a month, you've got to have $1,200 a month in net income coming in to support that from a coverage ratio perspective. We can be a contributor to capital for bank debt, but a lot of times, if your profits aren't sufficient to cover your debt service requirements, more debt isn't the answer to it. That's very important. You know, bankers should sit down with you and say, you know, they have just much of an obligation to say, no, this isn't the right way to do this, but here's what we can do for you. And that may require some more cash injection from the owner's perspective at that point. It could be someone else that you may know that may be willing to invest in the company that would offer some cash equity into the business. Or it could be, let's slow down the growth of the business for a period of time and let the profits catch up with it as well. There's a lot of different scenarios that could take place with that. But listen, you got to make sure that you get your income statement and your balance sheet structured properly in order for you not to choke off your cash flow as well, because you're always going to be scrambling at that point. It just happens. Once you get behind a little bit, it's harder and harder to catch up unless your revenue streams increase. Now, with that, you know, we've seen a lot of businesses, and particularly, you know, in your lines of business as well, where you get a large contract. You get one large contract, and boy, you won that. Hopefully, your net margin on that is sufficient, but you're going to need people, and you're going to need equipment, and you're going to need things to get to execute and to make sure you perform on that contract. That's where a letter or a line of credit comes into play as well. Then, you know, if you know, you've got a lot of different cycles in your cash flow, and if you get one large contract, you advise the bank ahead of time or let the bank know ahead of time. The answer to that is yes. You know, bankers generally don't like to be surprised. So if you know on the front end that you're going to be having either seasonality of your cash flows or you're going to be receiving large contracts, it's always to know better on the front end so that we can structure the debt properly to allow you to be able to execute again on those contracts. And generally speaking, if you've got a large space in between, you know, the time that you start your jobs and the time that you get paid for those jobs, which happens, I'm sure, frequently in your business, that's where a line of credit really becomes very, very important or helpful to you. And the bank can provide the line of credit for you, because that is designed to, just for that purpose, is to provide you with the cash flow that you need for those gaps from the time that you start the job to the time you get paid and then final completion of it. The important thing in that, though, is making sure that when the revenues do come in, that you do in fact pay down on that line of credit. Because what we see a lot of is we advance on the line because they have these large expenses on jobs, but when the money starts coming in, they don't pay that line down. Then guess what happens? The next job comes in, and they don't have enough room on that line of credit, and now they've spent that money, and now they're scrambling. And that's where the danger comes into play. You know, so if you need, like I said, major pieces of equipment, or you're buying your building, or whatever it might be, capital expenditures, those are term types of debt requests, generally speaking. So those you want to set up so that you're paying for that with money that's going to come in over time. Okay, as opposed to working capital lines of credit, which are designed for and should be used for those fluctuations in your monthly cash flow, which, you know, are used with short-term dollars used to pay short-term debt. Because sometimes you can get a mismatch where you're taking, you know, short-term income and you're paying off long-term debt. Well, then, you know, and then your cash flow dries up again. Now you've got that gap in there. So, you know, the structure of your debt is very, very important from that perspective, in that want to make sure that you match your debt structure so that any payments that you have on capital items, which are going to last you, and your depreciation schedules and everything that go along with that, are going to make sure that you want to set that up on an amortizing basis so that you're not choking off your short-term cash flow in the process. So if you've got those needs, if you've got both a capital expense need from a borrowing perspective and seasonality cash flow needs from working capital, two different things, you can, you know, you can talk about them at the same time, you can negotiate it at the same time, but it's really the bank's, I think, responsibility too to help you in determining what the right structure is for that too. It's very, very important for the banker to do that. So is the interest rate the same on long-term or amortizing debt versus working capital lines of credit? Generally not. Generally, because what the bank will do is try and offset its interest rate risk a little bit, because short-term working capital lines are generally 1 year or less. Let's just use 5 years out there. I don't know where interest rates are going to be 2 years from now, 3 years, 4 years, or even 5 years from now. So we've got to offset that a little bit of that potential risk of interest rates going up. So they're not going to be materially different, but you might see a half a point difference between a short-term interest request or loan request for working capital as opposed to an amortizing loan, just to offset that interest rate risk a little bit. But that's a negotiable item too. If I'm with a lender and I've got a debt structure with lenders, when's the appropriate time to start talking to them about not restructuring, but refinancing or adjusting my interest rate on my loans? There's never a good time for that because here's the scenario that could happen, and this has happened. So people start renegotiating their rates with the bank, particularly on long-term amortizing debt, not short-term, because short-term rates are pretty easy to predict across the spectrum. But on long-term amortizing debt, so let's say you've had a loan that on equipment that is started amortizing a year ago. Well, you got a pretty good rate back then, but what we started to see is today. So if your rate was low back then, are they going to be lower today? They may be lower today, but then the trick is, and just like timing the market as well, you can't time it. But when do you make sure that you time it to a point so that if you can renegotiate that interest rate with your lender, what's the best time to do that? Because if interest rates go lower again, which in this rate environment I would see that hard to happen, but it could, and it has. But then now you're leaving money on the table. So I don't know if there's a real good time to do it. You just and it's really up to you to have that conversation with your lender, too, your banker. What do you think? Where do you think interest rates are going? Is this the right time for me to be talking to you about adjusting my interest rate? A bank should be pricing their loan or the request for the loan based upon the element of risk that's inherent in that loan. It's a little bit higher risk where there's not as much collateral or the cash flow is a little bit thinner, the interest rate might be a little bit higher. But at least you're getting what you need to help your business. But there's more risk to the bank. But if it's, the cash flows are great and you got a great client list and you're not, been profitable, you've got some leverage with your financial institution at that point, your lender at that point in time. So it wouldn't be bad to have that conversation periodically with them. I've got the cash, I've got to pay down my debt. Debt is not necessarily a bad thing. It can work really well for you. If it's structured right, debt can be good for you. You need it sometimes. And in today's rate environment, I would probably argue that if you start paying down debt at these interest rates, at the risk of, reducing your available cash, so that if your business starts growing again, I don't know that I would necessarily make that recommendation to start paying down debt right away on these low interest rates, because it's not free, but it's pretty close. It is. And particularly, if you've got some equipment that you're depreciating too and what have you, it's a pretty good environment right now from a leverage perspective, debt perspective right now. Receivables, we know that that's always an issue in the trades, and the thing we always look at from a lending perspective on receivables and contract receivables, particularly here, is how many do you have? So what's the mix of your receivables in there? Do you have a good list of clients that are contributing to your receivables? Or are you concentrated with one or two major subs or customers that are really your bread and butter for you? And we look at that, and what we like to see is a large, not a large, but a nice diverse list of receivables, because that means you've got a lot of different clients in there and you're not reliant on one or two major customers. Yeah, so how do you manage the receivables? What's the best way to manage receivables? And the operative word there is manage receivables, obviously, because it does become a problem. You're all busy in the field, you're all busy in your businesses. I would say that what I have seen is those people that really dedicate a individual or some individuals, if it's a large business, but an individual on managing their receivables and their payables too, because you can get just as much trouble if you extend your payables too. But if collecting your receivables, you have to have people working those receivables all the time. If you have somebody dedicated to working those receivables, generally speaking, you're going to get good results from it. If you just say, well, I'll wait for another week, they'll pay me in another week, they always have paid me. Trust me, you've seen it as well. If you give anybody an opportunity to, because what you're doing, if you're extending them by 60 days or 90 days, you're their bank. You're their bank. They're getting free money from you at that point. So when we get a new client request or new potential customer coming in, what do we look at as a bank or a banker? There are several things we look at. First of all, there's nothing more important than just sitting down across the table from somebody and talking to them. Because again, we look at it as being your trusted advisor, one of your trusted advisors. My philosophy has always been, I want to know as much about your business as I possibly can, and I'll get to know as much about your business as I possibly can, because at that point, then I can help you tailor a package that is going to fit your needs. But I want to learn as much as I can about your business, but I don't want to tell you how to run your business, because that's very important. There's a lot of bankers that will try and tell you how to run your business too. I'm not going to ever tell you. I don't think none of us will ever, in our organization, will ever tell you how to run your business. But we want to know as much as we can. So there's nothing more important than sitting across the table and just talking about what your challenges are. If you've got income streams coming in, you got large contracts coming in, what your current debt structure is, what your trends have been, historically trends. We always look at historical trends, so we try and look at 3 years of trending as well, because that's a good indicator too. Are you having declining revenues? You having or increasing revenues, or profits? Are your profit margins different, and what's contributing to that? So it's just an interview process basically that becomes very, very important for us. But at the end of the day, people always ask me, well, how do you ultimately make your decision? Well, it's a lot of things. It's all of that. It's the collateral. It's the strength of the individual behind it as a guarantor, perhaps on that loan as well. But at the end of the day, and this is 35, 40 years of banking experience, I look you in the eye, and if you tell me you're going to pay me back, that's important. Character is still an important element when it comes to lending. I would always say that if you can come prepared with a business plan, every business needs a business plan. And it doesn't have to be a detailed, written out business plan. But you've got to have something in the back of your mind that you can put on a piece of paper that knows where you want to be and how you're going to get there. Because without that roadmap, it's just conversation then at that point. But if you can put it on a piece of paper, and then I or a banker can ask you, well, how are you going to execute on that plan then? What are your plans to execute so you're going to increase your revenues? If revenues have been a challenge, how are you going to do that? What's the marketing strategy behind that, which should be in the business plan as well. That's an important, and I don't want to say document, but that's an important function, I think, of the entire analysis for someone new coming in that we don't have any experience with. Or even somebody that we do have experience with. Sometimes if they're trying to grow their business, it becomes very, very important too, the business plan. But most businesses don't, and again, we can help you with that. A banker should be able to help you with that. So when you come to me and they say, where's your business plan? Here's what I'd like to see in it. We can sit down and help you to tailor a business plan to what you're trying to do. Or we have resources available as well, and third-party resources available to us as well. But the business plan becomes very, very important. And it's important for you too, not just from the lender's perspective, but it gives you the roadmap that you need. Because if you're having challenges, if you identify those challenges, you should be able to address those through some sort of marketing strategy, business development strategy, debt restructuring strategy, whatever it might be. But it can all be done should be done in a business plan of some sort. And it'll need to be modified from time to time as well. What else?
Succession planning. Can you touch on that a little bit?
Succession planning in businesses? Sure, absolutely. It's a critical issue. And when I say critical issue, it's a critical issue. Because most businesses that we see today don't have really any kind of a form of succession planning. So if you're the principal in the business and you get hit by that beer truck tonight driving home, what's going to happen to your business? Can it sustain the loss of the principal in the business? Will it struggle? Will it fold because you don't have a succession plan? more times than not, what happens is they struggle to survive, and before you know it, they're no longer in business. So succession planning is extremely important, and unfortunately is not something people think about too much, because everyone thinks, myself included, that we're invincible. Nothing's ever going to happen to us. So you've got to protect yourselves. Sometimes what we see in businesses too, and what we'll do is, if we see that there's no succession plan in the organization, we'll ask for life insurance to cover the debt. So if something happens to the principal, at least we know that we've got an assignment of some life insurance just in case something ever happens to the business. But it's a critical issue that and something maybe that would be a good topic for a workshop sometime, because we've got resources available for this too, that addresses succession planning, tax planning, all those different elements that you don't think too much about, because they're very, very important in not only your current income, but your future income as well. But all of those things require advanced planning in there. Yeah, so the question is, if you've got individuals within a company that perhaps want to buy into the business, or you as a business owner want to bring them into your business as well, what's the best way to do that? Again, there's a lot of variables that go into play with that. It just depends upon, if you're the business owner, are you at that point in time in your career where you're ready to sell it and start moving it to other people, move it into other people? Or do you want to retain a percentage of ownership in that as well? And if you want to retain a percentage of ownership, do you still want controlling interest in it as well? And that you can control through some sort of a buy-sell agreement that, over time, individual A and individual B are going to be able to acquire more and more stock in the business based upon the profits of the company, based on my age, based on a lot of different variables that go into it. But every transaction is just a little bit differently. Now, depending upon the size of the organization too, we've seen some ESOP buyouts. If there's a large group of people where the employees over time can, and there's some tax advantages for the business owner to do it this way as well, can sell the company to key employees through an ESOP type of program, employee stock option program as well. Gets fairly complicated, and you really need a good CPA and attorney to help you through that, but we have seen that happen many, many times as well. But if you just ultimately want to transfer ownership to an individual in the business, whether it be a family member, which is important as well, you just don't want to automatically hand over the reins, a family member or otherwise, or key employee, the best way to do that is just develop, I think, certain criteria that have to be met over time, and allow them to continue to acquire stock or purchase the business from you at some point in time when you're ready to step away. And then again, that's where the bank can come into play as well, is how can I help your key employee acquire that business interest as well? Because chances are that employee is not going to be able to come up with $500,000 in cash to finance that acquisition. So that's where the bank comes into play as well. If it's a known that you want to structure a sellout or an acquisition, if you're the person buying it, I think the best thing to do, quite honestly, if you know that's going to happen, is you get on the front end of this thing with your banker and your accountant, and you sit down at the table and say, how can we effectuate this? How can we make this happen? What's the best way to make this happen? And you sit down and you have that conversation, not just the two people, the two parties, but bring in the banker and the accountant as well in those conversations, because the banker will tell you, here's how we can finance it. The accountant will tell you, from a tax perspective, Mr. Business Owner or Mrs. Business Owner, this is the best way for you to structure this as well. Very important from tax planning perspective too, because you just don't want to sell it and then you have these capital gains taxes that you're going to have to pay as well. So you want to make sure you're on the front end of that thing and getting the banker and the accountant particularly, and your attorney for that matter too. But every time you pick up the phone with the attorney, they charge you, so bring them in later. The pitfalls of a business owner financing a buyout. I don't know. I think it's the same thing that I guess I would look at as the lender myself in it is, am I going to get paid for it? And what are the tax consequences to you as well, which your tax accountant, your accountant would have to tell you. There's probably some advantages to doing that over time, but the other risk to that is, God forbid, something happens to you in a year from now, and your buyout was over the next 5 years. What happens to that other 4 years worth of buyout money? Does it go to your estate? I mean, you can do that, structure that through some sort of a buy-sell agreement, I suppose, but are you going to be able to realize all of your income potential from that if you finance it yourself? You can do it. I've seen that happen too. I've seen that happen where, generally speaking, if the purchaser doesn't have cash and they don't want it and they can't qualify for debt with the bank, the buyer or the seller is willing to finance that for them, but they're going to get a nice premium for that. And that means you're going to charge a nice interest rate back to them to do that because you're taking the risk on it. But that's happened before too, where if they're not bankable for whatever reason it might be, that the business owner ends up financing a portion of it, if not all of it. I've seen it happen where the bank will finance a certain percentage of it and the seller will carry back a certain percentage of it as well. The bank's always going to require, generally speaking in those circumstances though, that any debt to the seller is going to be subordinate to the debt of the bank. So we're going to get paid before the seller is going to get paid if there's a bank involved.